Thank you, friends, for switching on to their website today. And today's session, we want to look at branches. Remember, from the previous sessions, we have introduced branches. We have looked at dependent branches. We have looked at independent branches. But now, this session, we want to not only look at independent branches, but we look at an illustration for independent branches. So do not forget, is your host none other than Mr. Spotter Fred. So here we go. We are talking about branches. We talked about types of branches. Types of branches. We have looked at one. We have looked at dependent branches. We have looked at independent branches. Then there is foreign branches. Now, friends, just to remind you, when you talk of branches, this is where an organization has grown too large to an extent that they now sell their services or their goods and services through various outlets. These various outlets are what we refer to branches. Now, we have looked at dependent branches in our previous session. We have been looking at independent branches. We have not yet talked about the foreign branches. So let's look at the independent branches. Remember, we have talked about independent branches together with an illustration. So we are looking at independent branches. Independent branches. Independent branches. So that's what we are doing. Remember, in our previous session, we introduced independent branches. This session, we are not only talking about it, but we want to really look at an illustration of independent branches. So independent branches, these are branches that will prepare their own books of accounts and prepare their financial statements. I need to remind you this, that we have the branches and we have the head office. Both the head office and the branches should prepare proper books of accounts in order to monitor the transactions between the head office and the branches. I also need to remind you that in the books of the branches, we maintain an head office current account to record all the transactions between the branch and the head office. I also need to remind you, friends, that in the books of the head office, we maintain a branch current account that will be recording all the transactions of the head office and the branch. So let me remind you that in the books of the head office, just as I remind you, we maintain, among other accounts, we maintain our branch current account, the branch current account, and many other. We have other items like we have the goods sent. We have the goods sent account. We have the bank account. We have the bank account. We have other assets account, just as usual. That's one of those items that we need to open in the books. While in the books of the branch, friends, just to remind you, we have what we refer to the head office current account. We have the head office current account. Well, not only that, we may have the goods received account, goods received account. We may also have something to do with the branch bank or cash account and what have you. So those are some of the main items you need to remember. Then the books of the head office, we have a branch current account, while in the books of the branch, we have the head office current account. The branch current account and the head office current account are maintained on a reciprocal basis, and the balances in the branch current account should be opposite and equal to that of the head office current account. Now, that one takes us to an illustration question. There is an illustration question that was examined it was examined. There are two illustration questions, which one we are going to do it here, and one will be an assignment. So there are two illustration questions. One is a question that was done somewhere in maybe 2000 there, and the other one was a question that was done around in 2001. So let me do the one that we are going to do here, and the other will be an assignment that I'll be giving you, of which you can also access our solutions from the website. Don't forget that this one will be an illustration that we are going to do here, while the other one is an assignment, which in the solution, we have also discussed the solution in our website, and I will advise you to look at it before you access the website for the solution. Now, we are looking at question 1. This illustration question, Nyatuka Enterprises operates 2 branches, one in the head office in Nairobi and the other in Busia. Purchases of stock are made exclusively by the head office branch, which does some modification to the stocks before they are sold. Goods are sent to the Busia branch at modified cost plus 10%, and all sales by both Busia branch and head office branch are made at a gross profit of 25% on the modified costs. The trial balances as of 30 June 2015, before taking account of the undermentioned adjustments, were Nairobi branch and Busia branch. In this question, we are saying Nyatuka Enterprises operates 2 branches, one in the head office in Nairobi and another in Kegogi. Purchases of stock are made exclusively by the head office branch, which does some modification to the stocks before they are sold. Goods are sent to the Kegogi branch at modified cost plus 10%, and all sales by both Kegogi branch and the head office branch are made at a gross profit of 25% on the modified cost. The trial balance as at 30 June 2015, before taking account of the undermentioned adjustment, were, we have been given the Nairobi branch and Kegogi branch. There is capital, there is purchases, cost of modification, drawings by the owner, sales, goods sent to or received by the branch, selling and general expenses, debtors and creditors, branch and head office current accounts, bank balances. We have additional information, friends. 1. Goods worth 220,000 shillings sent to the Kegogi branch in June 2015 were not received or recorded by the branch until July 2015, while a remittance of 421,500 from the Kegogi branch to the head office in June 2015 was not received or recorded at the head office until August 2015. Any adjustment in respect of these items are to be made in the head office accounts. There was a shortage in stocks of a selling value of 100,000 shillings at the Kegogi branch. There was no shortage of surplus of the head office. 3. Unmodified goods costing 500,000 shillings were at the Nairobi branch as of 30 June 2015. 4. There was no loss or wastage in the process of modification of stocks by the head office. The branches handles only goods received from the head office. Required. Prepare in columnar form for the Nairobi branch, Kegogi branch, and the combined business. A. The trading and profit and loss account, or rather we call it the income statement or the statement of profit or loss for the year ended 30 June 2015, and then the statement of financial position as of 30 June 2015. That's what we are required to do. Now, we start from the required point of view. From the required point of view, you are told to prepare in columnar format the income statement and the statement of financial position for the Nairobi branch. Nairobi branch is the head office branch. Then we have the Kegogi branch and the combined business. We are required to prepare for the year ended 30 June 2015. So it means that our year begins on 1st July. It begins on 1st July and ends on 30 June the following year. That's important to note. Now, we go back to the information from the beginning. We have been told that these Nyatuka Enterprises, They have how many branches? There are 2 branches. Then that's one is in Nairobi and the other one is far away, Kegogi. That's very far away. Now, purchases of stock are made exclusively by the head office branch, which does some modification to the stocks before they are sold. That's okay. That they mean they must do some modification. They must modify some goods before they are sent to Kegogi branch. So the head office at Nairobi must modify these goods, and then they send, after modification, they send them to Kegogi branch. Now remember, we have been told that goods are sent to Kegogi branch at modified cost plus 10%, and all sales by both Kegogi branch and the head office branch are made at a gross profit of 25% on the modified cost. Now, what they are saying important there is the invoice price. The goods are sent to the branch at what price? So we are saying one of as an illustration from paragraph 1, we have been told that goods are sent to Kegogi branch at a modified cost. Invoice price to Kegogi branch is at modified costs plus, they have told us, a modified cost plus 10%, plus 10%. Now, in other case, when they tell you modified cost plus, definitely there's a markup. So the markup is 10%. We are sending these goods to the branch at a markup of 10%. Now, what we do here, we may assume that our modified costs, you know, the element is cost, is equal to 100%. So the invoice price to branch will definitely be 100% plus 10%. That comes to 110%. That's important. So we have that our goods are sent to the Kegogi branch at 110%. Then we have been told that both Kegogi branch and the head office branch, they are all sales by both Kegogi branch and head office branch are made at a gross profit of 25% on the modified cost. So what are they saying? Apart from that, they are saying that sales, all sales at modified costs plus 25%. They have also given us a markup, that the markup is 25% on sales. This means that our costs, our selling price is 100%, because our modified cost is 100% plus the 25%. That makes it to be 125%. That's the selling price. Or I could just say that if we are be given a markup, the markup is 25%, which is a quarter. What would be our margin? Our margin is 1/5. Remember, this business of markup or margin, I need to remind you once again that if you talk of a markup, we are saying it is the gross profit over cost of sales, which is the same as gross profit over sales minus gross profit. And we can say that this is maybe A over B. We can also talk about the margin. The margin is simply the gross profit over sales, which is the same as gross profit over cost of sales plus gross profit. You need to remember that. So that's something that we talked about, dependent branches. So we have a markup, we have a margin, and that is important. You cannot use a markup on sales to get the profit. You can use a margin on cost of sales to get the gross profit. It's not possible that way. It doesn't work that way. So if you're given a markup, you can easily get a margin. let's say that our markup is A over B, then it means that our margin will be A over B plus A. That's important. So you need to remember this concept. Fine. So we know that the selling price is 125% and the invoice price to the branch is 110%. Then we move on to the next business. We are looking at the trial balance. We'll be given the trial balance of Nairobi branch and Kegogi branch, the capital purchases, cost of modification. It means we must modify these goods before we send them. Cost of modification, therefore, is an inventoriable cost. It's going to be part and parcel of our goods available for sale, or is going to be part and parcel of our purchases, or is going to be part and parcel of our cost of sales. Drawings by the owner, this is an enterprise. We have sales, we have goods sent, we have sales and general expenses, we have the debtors, we have the branch, we have the bank balance. That's okay. Now, something important as well, if you go back to the trial balance, you realize that we have the element of goods sent to and goods received by the branch. The goods sent to the branch is 4620, while the goods received by the branch is 4400. You realize that there's a difference there. That difference is either goods in transit. If they are not in transit, then they must have been damaged in transit. So they have sent 4620, but what has been received is 4400. So in that case, there is some goods in transit, or they must have been stolen in transit if they are not there. So we have that. We may be told that in additional information. Then we have also been given the branch and head office current account. The branch current account is 1949, while the head office current account is 1307.5. Now, friends, don't forget that in the books of Nairobi branch, we are maintaining a branch current account, while in the books of Kegogi branch, we are maintaining an head office current account. So don't forget that. In the books of Nairobi branch, the branch current account balance is 1949, while in the books of Kegogi branch, the head office current account balance is 1307.5. That's important. Then we have the bank balances, no problem there. Those are current assets. Additional information. Goods worth 220,000 were sent to the Kegogi branch in June 2015 were not received or recorded by the branch until July 2015, while a remittance of 421,500 from the Kegogi branch to the head office in June 2015 was not received or recorded at the head office until August 2015. Any adjustment with respect of these items were to be made in the books in the head office accounts. That's okay, because what they have told us in note number 1 is about the goods in transit and the cash in transit. Goods in transit is 220,000 because it had not been received at the balance sheet date. We can confirm that point if you go back to the trial balance. If you go back to the trial balance, you compare the goods sent and the goods received, you realize that there's a difference of 220, and that's what we have been told in addition information number 1. We also have the cash in transit because it had not been received. This cash of 421,500 had not been received at the balance sheet date, so that means it's a cash in transit. Number 2, there was a shortage in stocks of a selling value of 100,000 at the Kegogi branch. There was no shortage of surplus at the head office. Friends, you need to remember, if there's a shortage at the branch, then that shortage at the branch should be recognized at a cost plus a markup. Then it means it should be recognized at 110%. While at the combined business, we should recognize it purely at costs. So this one was a shortage at the branch, and we're going to, the figure given there of 100,000 is the selling price. We need the cost plus a markup and the original cost as well. Maybe that's one of the workings we can do. We can also do that working. Let me call this working 1, and then we come and say working 2. Working 2, we have the shortages at Kegogi branch. The selling price, friends, is something to do with the 100,000. So, the selling price, which is at 125%, is equal to 100,000. We need the costs plus a markup, which is at 110%. we also need the original costs, which is at 100%. What will it be? So the cost plus a markup is going to be 110 by 100,000 over 125. While the original cost is going to be 100 times 100,000, you divide by 125. So that's very important. I take my calculator. I say 110 this is 88,000. This is 80,000. So the 88,000 will be reported in the branch income statement, while in the 80,000 will be reported in the combined business. That's important. So those are the shortages. And if there are shortages, if they were never compensated, then we are going to debit our income statement, we write it off, and we credit our cost of sales. But in case they were to be compensated by the insurance company, you'll debit your claims receivable, you credit your cost of sales. If they are to be compensated by the insurance company, you debit your claims receivable, you credit your cost of sales. That's what we should do. And maybe I could say this, because as part of revision, in if no compensation expected, debit our income statement, our branch income statement, or let me just say profit or loss, then you credit your cost of sales. If, let me call this A or this B, if compensation from insurance company is expected, then we are going to debit our claims receivable, then we credit our cost of sales. When I say credit cost of sales, we clearly say credit purchases. There's no problem in that. So that's exactly the position. Now, in number 3, we have been told unmodified goods costing 500,000 were at Nairobi branch as of 30 June 2015. So there are some goods which have not been modified. Remember, friends, we cannot sell or send goods if they have not been modified. We must modify them before we send it to the branch or before we sell it to outsiders. So the unmodified goods will be adjusted from the goods available for sale, and the unmodified goods as well will be remembered and recognized as part of the current assets. Then number 4, there was no loss or wastage in the process of modification of stock by the head office. The branch handles only goods received from the head office. That's okay. Now, one thing you also need to remember, or a working that you need to remember to do, is the determination of the closing stocks, or rather the combined. We didn't have the opening stocks, so if we had the opening stock, we could have determined the combined opening stock. But with this one, we need to determine the closing stocks only. The closing stock of the head office, the closing stock of the branch, and the combined closing stock. We are not given that. So we need to go ahead and use and do the necessary workings for the same. So we are saying working number 3, determine the head office closing stock. We are not given the closing stock, so we need to do that working. Now, one thing you need to know, remember, that when we are determining the cost of sales, we simply take the opening stock, we add the purchases, we less the closing stock. That's basic knowledge. But now we want to make the closing stock the subject of the formula. We want to make the closing stock the subject of the formula. If we make the closing stock the subject of the formula, we are going to have the opening stock plus purchases minus cost of sales. Simple. But because we are in the books of the head office, you need to remember that apart from the opening stock and purchases, there is modification costs. That is an inventoriable cost. Apart from that as well, we have the cost of sales. This cost of sales does not only have the element of goods sold to the public, but there are also some goods which are sent to the branch. So there are two elements under cost of sales. There is goods sent to the branch. There's also some goods sold to the public. We need to get the cost of sales for each. So that's it. So we come and say, we start with the opening stock. We start with the opening stock. From this, we didn't have the opening stock. But if we had it, we could also be required to calculate the combined opening stock. But we don't have the opening stock. So we add the purchases. We add the purchases. You move on and realize that purchases given there, friends, is 9,487,000. Our figures are in thousands. For 9 million, that is 847. Then we are going to add modification, cost of modification. The cost of modification is 252.5. Then on that, we are going to less the cost of sales. No, before cost of sales, friends, there's some unmodified. There's some unmodified, so less unmodified. Goods must be modified before they are sent or before they are sold. So the unmodified note number 3, that is note 3, unmodified is 500. So the goods available for sale, so I take my calculator, I say 94, 9847.5 plus 252.5 minus 500. That comes to 9,600. Then I less the cost of sales. The cost of sales to third parties, we are going to have, you know that our sales are at 125%. So you go back to the trial balance, you realize that at the head office, we have sold a total of 6.4 million. So we must have sold it at 125%. We must have sold it at 125%. So this is 6,400. Then we have the costs, which will be at 100%. So what is that cost? So I take my calculator, friends. I say 100 by 6,400 divided by 125. So I'm getting 5120. Apart from that, friends, we also have less cost of goods sent to branch. Don't forget the cost of goods sent to the branch. Here we send goods to the branch at a cost plus a markup. That is at 110%. at 110%. We go back to the trial balance and determine the amount of goods that we send to the branch, the value of goods sent to the branch. We send to the branch 4620. So the 4620 is equivalent to 110%. So we ask ourselves, what is our cost, which is definitely at 100%. What will it be? Now in this case, friends, we are talking about 100 by 4620 divided by 110. Then we have and talk about 4 to 100. Apart from that, friends, we may have, this one we didn't have it, we may have shortages. If we have the shortages at the head office, recognize them at costs. We didn't have it. We didn't have the shortages. The shortages we had was at the branch. So shortages may be goods damaged, goods stolen, something like that. If we have something like that, shortages, goods stolen, goods damaged, then you adjust them accordingly. This one we didn't have it, friends. So at this point, we are able to say that our head office closing stock, I'm taking 9,600 minus 5120 minus 4,200. What are we getting? That is 280. That's our closing stock. I may be forced to write it somewhere because I need it. The head office closing stock, 280. That's perfect.